The collapse no one saw coming. Welcome to FluxFolio Finance, where we uncover the stories that move markets and reshape money. Tonight, we're diving into a corporate collapse that most investors didn't see coming, but which may be the first tremor of something far larger. An American auto parts company called First Brands Group has fallen into bankruptcy, leaving behind up to $12 billion in missing or duplicated receivables. It's not just a scandal about accounting errors, it's a warning about how modern credit works in the shadows. When we peel back the layers, we discover a financial ecosystem built on trust, leverage, and opacity, and one small failure that reveals how fragile that system really is. Who is First Brands, the quiet giant behind the shelf? For most people, First Brands was invisible. It sold the ordinary: filters, brake pads, wiper blades, the kinds of products every driver uses but never thinks about. The company grew quickly through acquisitions, financed by loans, and by selling its future payments to investors through something called invoice factoring. In theory, it's simple. A company sells its unpaid invoices to a lender at a discount, getting cash immediately instead of waiting for customers to pay. In practice, it's a high-wire act that only works when everyone in the chain, from auditors to lenders, believes the invoices are real. At First Brands, that trust broke completely. By late 2025, the company filed for Chapter 11 bankruptcy, and investigators discovered that the same invoices had been sold multiple times to different lenders. A basic liquidity tool had become a billion-dollar illusion. The numbers that don't add up. The shock began when Raystone Capital, one of First Brands' creditors, claimed that $2.3 billion had simply vanished. Other lenders soon realized their collateral overlapped. They all believed they owned the same receivables. Jefferies Financial Group disclosed $715 million in exposure through its Point Bonita Capital Fund. UBS funds reportedly held nearly 30% of the total receivable pool. A Japanese consortium led by Norinchukin Bank and Mitsui & Co. faced another $1.7 billion at risk. Each firm believed it had verified documentation. Each assumed the other investors had different invoices. When auditors traced the flows, they found a labyrinth of overlapping contracts, circular payments, and missing cash. By the time the bankruptcy court stepped in, liabilities were estimated between $10 billion and $50 billion, with assets far below that range. The market suddenly realized this wasn't a bookkeeping error, it was a systemic blind spot. How factoring became the financial Wild West. To understand why no one noticed earlier, we need to understand factoring. Factoring isn't new, it's centuries old. But in the last decade, it has evolved into a trillion-dollar industry powered by fintech platforms and private credit funds. Instead of traditional banks buying receivables, the buyers are now hedge funds, BDCs, and asset managers hungry for yield. They lend against invoices that are supposedly backed by real trade flows, yet there's no centralized registry to verify who owns what. If the same invoice is pledged twice, there's no system alert. That's how First Brands turned cash flow management into a Ponzi-style financing loop, using today's debt to pay off yesterday's lenders. And it's how a mid-sized parts supplier ended up shaking confidence in a global financial market worth $2 trillion. The shadow banking chain reaction. Behind every factoring deal stands a deeper source of money. Private credit funds borrow from banks and institutional investors, often using short-term funding to finance long-term receivables. When those receivables collapse, the losses cascade back through the chain. That's what economists call the shadow banking feedback loop. Non-bank lenders depend on banks for liquidity, while banks depend on them to extend riskier credit outside the regulated system. So when a company like First Brands defaults, the pain doesn't stop with its direct lenders. It can squeeze the banks behind them, the investors funding the banks, and eventually the credit available to the broader economy. The structure is opaque, the exposures are overlapping, and the shock waves move faster than regulators can track. A familiar pattern, Greensill 2.0. If this story sounds familiar, that's because we've seen it before. In 2021, Greensill Capital collapsed after packaging and selling questionable receivables to major investors, including Credit Suisse. That event was dismissed as a one-off scandal. 4 years later, First Brands is proving it was a symptom of something much larger, a global addiction to private credit and yield. Both companies operated in the shadows of traditional banking. Both blurred the line between legitimate financing and synthetic liquidity. And both revealed how fragile confidence can be when lenders no longer know what their collateral is actually worth. The difference is scale. Since Greensill's fall, private credit assets have doubled, and the market's reliance on similar structures has deepened. First Brands is not an anomaly, it's a preview. Market ripples and the fear of contagion. The immediate market reaction was cautious but telling. Jefferies' stock slipped nearly 10% in the days after disclosure. UBS quietly reduced the size of its trade finance portfolios. Fitch Ratings issued a special note calling First Brands a warning shot for direct lending markets. Meanwhile, private credit funds across the US and Europe began auditing their own receivables, looking for hidden duplication. For now, the damage seems contained. But what truly worries investors is not the loss itself, it's the loss of trust. When one invoice can belong to 3 lenders at once, every similar asset starts to look suspicious. And in finance, suspicion spreads faster than default. The regulatory blind spot. How did regulators miss it? Because factoring lives in a gray zone. It isn't a security, so it doesn't fall under capital markets oversight. It isn't a loan in the traditional sense, so it escapes banking supervision. Auditors only verify balances, not ownership duplication. There's no centralized clearing system, no requirement for disclosure, and little coordination between jurisdictions. Even within the US, state-level rules differ on how receivables are registered. That opacity is the reason why First Brands could operate for years without raising red flags. By the time creditors compared notes, the overlap had already consumed billions. It's the same regulatory gap that allowed shadow mortgage products to flourish before 2008, a gap created by innovation moving faster than oversight. From liquidity to leverage, the real risk. When interest rates rose sharply in 2024 and 2025, many companies faced higher borrowing costs. To preserve cash, they turned to factoring to convert sales into immediate liquidity. But the flood of receivable financing created a chain of leverage nobody fully understood. Every time an invoice was sold, another layer of debt was added to the system. Funds borrowed from banks, banks lent to other funds, and everyone assumed the invoices were safe collateral. In reality, they were as fragile as subprime mortgages once were, assets that looked diverse on paper, but were all exposed to the same credit event. First Brands was the weakest link, and when it snapped, the illusion of safety broke with it. A slow-motion shock to confidence. Unlike a stock market crash, this crisis doesn't erupt in one day. It unfolds slowly through the tightening of credit and the quiet repricing of risk. Banks start trimming funding lines to trade finance firms. Private credit funds hesitate to extend new loans. Corporations relying on factoring suddenly find their access to cash shrinking. The result is what economists call a liquidity drought, not visible on charts, but painfully real in cash flows and balance sheets. Every slowdown in trade finance, every cancelled facility, every delayed payment becomes a small echo of First Brands' collapse. And those echoes accumulate. The bigger picture, private credit's moment of truth. Private credit was supposed to be the safe alternative to volatile public markets, a world where disciplined investors lent directly to businesses they understood. But that world has become crowded, opaque, and leveraged. At over $2 trillion, the global private credit market now rivals the size of the US junk bond market, yet operates with far less transparency. The First Brands episode exposes the hidden weakness at its core. Most of these structures depend on perfect trust between counterparties. When that trust disappears, so does the liquidity that keeps the system running. Regulators now face a dilemma. If they tighten rules, credit availability shrinks. If they stay hands-off, the next collapse could be larger and faster. Either way, the age of blind faith in private credit is ending. Lessons for investors and policymakers. For investors, the message is straightforward. Follow the cash, not the headline yield. Ask where the collateral is, who verifies it, and how often it's audited. High yield without transparency is a red flag, not an opportunity. For policymakers, the First Brands case underscores the need for a receivables registry, a basic database to prevent multiple pledges of the same asset. It also highlights the growing overlap between banks and non-banks. Shadow banking is no longer in the shadows. It's intertwined with mainstream finance. Ignoring it risks repeating the cycle of hidden leverage that has defined every major financial crisis of the last century. The aftermath and the road ahead, investigations into First Brands are still unfolding. Executives have resigned, forensic accountants are tracing payments, and creditors are negotiating recoveries that may take years. But the real consequence is psychological. Every investor in trade finance from New York to Tokyo is now looking over their shoulder. The easy confidence that receivable-backed assets were safe yield has evaporated. And as that confidence erodes, funding costs rise, liquidity thins, and even healthy companies start to feel the squeeze. The system won't collapse overnight, but it will tighten, recalibrate, and maybe finally reform. When people think of financial crises, they imagine Wall Street, hedge funds, and exotic derivatives. Yet this story began with brake pads and windshield wipers. That's the unsettling part. Fragility often hides inside the ordinary. First Brands didn't invent a new scam. It exploited an old weakness in a new way. And it did so inside a financial system that prefers speed over scrutiny. The next shock may not look like a bank run or a stock crash. It may look like another ordinary company quietly running out of trust. The fall of First Brands is more than a bankruptcy headline. It's a mirror reflecting how much of today's financial world runs on assumption rather than verification. As investors, regulators, and citizens, our task is to see the system as it is, not as we wish it to be. Because somewhere in another corner of the market, another company is using the same playbook. And if we don't learn from this one, the next time the invoice comes due, it won't just be one firm paying the price. This is FluxFolio Finance, decoding money, revealing power, and helping you stay ahead of the next shock. Thanks for watching. Don't forget to like, subscribe, and share your thoughts below. Is this just one company's mistake, or the start of a much bigger unraveling in private credit?